The Ensemble podcast is intended for professional financial advisors. All discussion is limited to publicly available information and should not be interpreted as legal, professional, or financial advice. Ensemble does not hold an AFS license nor provide any financial services. Before making investment decisions, you should obtain financial advice from a qualified financial advisor.
Hello, my name's James Wrigley. I'm a financial advisor and one of the principals of Melbourne-based financial planning firm First Financial. I've been a long-term listener and contributor to the Ensemble group and podcast, picking up some amazing nuggets of gold over the years. And through this podcast and the people that I'm able to speak to and interview, hopefully I can continue to deliver some of those nuggets of gold to you.
This podcast series is brought to you by leading Australian life insurer TAL. TAL is committed to partnering with advisors to protect the financial well-being of their clients, now and into the future. TAL's accelerated protection products ensure your clients have access to cover options that are suited to their individual needs. Last financial year, TAL paid $2.7 billion in claims to nearly 40,000 customers.
Thanks. Welcome back. I'm James Wrigley. I don't know how to intro these podcasts. I've got to work on how I do that. So anyway, I'm James. Got two for the price of one today. Chris Bates and Craig Bigelow joined me today for the podcast. Thanks, guys, for joining me. Craig, I reached out to you, but we've got the two of you, which is even better. So thanks for joining me.
No worries.
Pleasure,
CB
mate.
and CB2, CB1 and CB2.
Chris and Craig. So that's it. So Craig, we'll maybe start with you, and I guess we'll get you both to intro yourselves. I'm sure lots of members of the Ensemble community are probably aware of the two of you, seeing that your faces pop up on LinkedIn or Instagram or wherever else it might be, podcasts in the past. But Craig, maybe if we start with you, can you give us a bit of your background and where you're at, what you're up to at the moment?
Yeah, so I guess it's changed a lot in the last 6 weeks. So it was almost 20 years in planning. The last at least 10 being primarily risk. And last year I merged businesses with VIA, and then late last year it was sort of just working out where I was at, and I guess I'd been a bit worn down by where risk was at, and I guess my role in that space. And I had to do a bit of thinking around what do I want to do for the next 10 years, and do I see myself doing the same thing? And I sort of sat on it for a while. Chris is helping us buy a house at the moment personally, and I had conversations with him and a few others, and just had a couple of months to think about it as well. And I just couldn't get over that answer of I can't see myself doing the risk for another 10 years. And so as much as it was challenging, I knew that I had to make a bit of a change. And the offer from Chris was pretty unique and amazing. And took the opportunity and jumped into something completely different, with a bit of personal hesitation as well, considering how much of my life was tied up to risk, and I felt my identity was in risk. So a little bit of a challenging one there for me personally as well.
So you were in Melbourne for a while. We caught up years ago at one of the cafes in the city. So you're living in Melbourne for a while. You've moved back to Sydney now?
Yeah. My wife works for Sea Folly, so we moved back up to Sydney for that. And so we've been back here for a little bit, but we're looking to buy back in Melbourne at the moment, and hopefully get back down when we can. But at the moment we're up in Sydney, so it's a bit of a transient.
And Chris, how about you? I'm sure anyone that's catching this podcast is probably well aware of who you are and what you're up to, but can you give us the bit of rundown on your story?
Oh, it's been obviously I got out of planning about 3 years ago. I gave the license back to Madison, and we've just sort of grown the mortgage broking business, and it's been a great journey. It's something we've really fallen in love with, it's a real passion. We've got a bit of a team going now, and on the personal side, it's double dad in the trenches, as they say. A 3 and 1 year old, and 0 to 9 a.m. Well, 4 a.m. 4 or 5 a.m. to 9 a.m. It's full on, and then 9 till 4 it's full on in the business, and then it's back to it. So things are good. Living up on the beaches, all the teams remote, so it's a pretty amazing. The shift in COVID, it's been amazing for the broking industry. I think it's been good for the advice industry as well in terms of digitalization and etc. Things are good.
Yeah. And so how big's the team now? Because it was just yourself in the beginning, wasn't it?
It was just myself, the solopreneur, the starting it out, ignorant, arrogant, thinking I knew what the world was doing, trying to do two different things at once, and didn't know who I wanted to work with, etc. So about 4.5 years ago, Ben joined. He was an ex-paraplanner. He ran a paraplanning outsource business through Malaysia and had like 20 staff there. He and I were friends for over a decade now, but about 6 or 7 years at that point. So he joined, then his brother joined, and then we've got 9 overseas at the moment. So then we've got a few extra people in Sydney, Melbourne, and Craig joined. Another guy starts next week. So totaling up now, we'll be getting close to 17, I think,
That's
in the
huge.
team. But it's a funny model. Like a lot of 2020, 2021 was a year of just significant growth. We went from, low 100 millions to over 300 million. And, we're up to probably selling about $1 billion this month. So as a broker, that's quite a, big number. But most brokers are done on an individual basis. Ours has been a team effort. And everyone basically works on every client. Like, we do somewhat to control it a little bit, but at different stages. But it's it's awesome. It's rather than a lot of broking models are just sort of silos, one broker and one support. And it's not a great efficient model because not everyone's playing to their key skill set, I guess.
Good.
So it's things are good.
Yeah. And Craig, maybe have a bit more chat about your experience in the risk space, because I know like you'd done a whole lot of work in automating like renewals and all of this stuff. Like we've spoken previously about the tech side of trying to make that a bit of a smoother process. Can you maybe touch on what you built there? And I'm interested in how you've decided risk's not for you going forward.
Yeah, I think at the end of the day, that's a passion for me. It's just like making things as efficient as they can be. And that was what I spent a lot of time doing. But when I sold my business, I worked out, I got a decent amount of money for that when I sold. But what I got paid because of the automation probably would have been the same if I had just written business the whole way through. So it was always a bit of a thing. You take your eye off the ball of new business to focus on the efficiencies and essentially end up in the same spot. But one thing that I take away from it is that if I hadn't have done that, I wouldn't then be able to have the knowledge to apply to something else. And so I guess this presents a new challenge for me to replicate that same thinking to something else that is another new challenge for me. And it's a good opportunity, as Chris said, given where they've come from to now. It's been an amazing growth journey. And I'm just trying to bring some of that thinking that I had previously to this new role and I guess take us into the future in a way that we can all work together and deliver on what we promise to more people, I guess. And that's really the challenge. And it's an exciting one for me because there's a lot of opportunity in there. And I think it's a chance to do it really well together, if that makes sense, rather than leaving what I'd learnt before. Yeah, okay, the widget's different, being lending versus risk, but the commitment to doing it as efficiently as possible to put clients at the center and deliver the best experience we possibly can is exactly the same.
So what's your role? What is your role? What's it going to morph into? What is it that you're doing within the business?
So to pretend that I'm an expert mortgage broker is completely untrue. I guess the challenge would be if you were to go out and put your hat up and say that you're a mortgage broker from day one, I think it doesn't sit comfortably with me. I've never bought a house personally. I've never done a loan. Actually, I think I did one in early 2000s when I thought it was a good idea to get into it. But I guess the unique position of it is that Chris has asked me to do nothing I'm not comfortable doing. So my role is to speak with potential partners and our partners and make that as tidy and efficient and clean as we can. Do the initial phone calls with people that are very similar to planning conversations, uncovering goals, uncovering needs, understanding what current and future plans are, gathering that information, exploring what things look like, not just for this current transaction, but into the future. And then I provide that information to the strategy team, and then they catch up with Chris to talk about property and strategy and how things from a banking policy, all the things that I don't know is not something that I have to have conversations with. So as Chris mentioned, with the team approach, it's everybody doing the things that they're good at rather than trying to pretend they're something that they're not. And then we've got the, the processing team and the engine room or the credit team that do all the applications, and then everything from there on, it's everybody's sticking to what they know.
Yeah, and so it sounds like, and Chris, maybe I'll get you to comment on it. It sounds like it's more than what I would anticipate of a normal broking relationship. You're not going, ANZ's going to lend you the most amount of money, off you go, and then the client is left to their own devices as to, well, what are they actually doing? What does the strategy look like? It sounds like it's more of almost a financial planning mindset around the lending that they're doing.
Yeah.
Can you talk us through what that looks like?
I mean, it is. I mean, I guess my heart's still as a planner, right? That's what I started as back in 2007. I became a mortgage broker. I was doing mortgage broking, planning meetings with mortgage brokers. And so it's hard for me to switch that hat off. And I think that was why it was hard for me to give up the license, even though I was so in love with the property conversation and guiding people on it. Because it was my identity. Now I just stick to my lane. I'm right. We work with advisors. I was not having the conversations around the other needs that I should, because I didn't have the relationships and I also had the license. And so it was a real enable of us just to let go. And, but the mindset still has to be there with debt advice and property advice. It's a big underserved need. And so we're definitely not facilitators or validators. And I happened to a client yesterday. He came in and he's like, I'm trying to buy some cheaper, lower end properties. He lives up in Newcastle, and then I'm going to do these duplex townhouses on them and sell them and make money. And it just won't work. And, and he was quite, stubborn in trying to say that he just wanted me to facilitate the loan. And the conversation ended because I said, we just won't facilitate and validate. Like, if you want to come on board with us, you need to be able to listen to what we've learned. And so absolutely, it's a financial planning mindset in terms of helping people think through, if we buy this apartment, what's going to happen after that in 5 years' time when you're telling me you want kids, or, you're telling me that things at work are really unsteady and you're not sure what's going to happen. Well, let's take a step back. Let's figure out get that clarity, I guess. And so the property side, we don't act as property buyer's agents. That's a key, sometimes misunderstanding. That is actually another amazing professional that you need, like a planner, like a great broker. You actually need, not always, but it's usually likely that a great buyer's agent will add a lot of value to your situation if you can afford their fee. And so what we do is we play as the middleman to them. We say, well, yeah, ultimately the best option for you right now is to upgrade in Sydney, or to buy your first home in Melbourne, or to buy an investment property in Brisbane or something. This is the best 2 or 3 buyer's agents we'd recommend. And we don't get paid for those referrals, but we know that they've been doing it 5 or 10 years. We know they've got that local market knowledge and they've got the relationships with the agents. And so, absolutely. I mean, I was sitting down I run little masterminds with, top brokers. I always reach out to, a top broker if I hear about them and have a chat and put a little group together. And I even ask them, these guys are doing well over $100 million a year. And, how do you guys feel about the property conversation? And everyone basically said, you just got to stay in your own lane. Your role is there to just provide the loan. And I just don't think that's good enough. I think that, we need to educate. We're in an informed position. We need to give them information that's going to help them, snowball, make a great decision that'll snowball into a better decision. And a few years ago, I did an XY, when it was XY, I did the broking / property course.
Yeah.
And that was probably where my thinking was. I was like, that's when I was leaving planning. I feel like I've got a real attachment and want to help the planning industry, with this conversation. And I wasn't sure how to do it. And so I thought, we'll do a course with XY. And over the years, that desire's still been there. And prior to Craig joining, I was like, I think the really way that I want to help is work with planners, give better advice and build better businesses by really solving this problem. And we went to a business coach who specializes in this sort of connection. We were building out a whole plan and a strategy. And then fortuitously, Craig's telling me that maybe he wants to get out of advice. And I'm like, well, this is what we're doing. We'd love to have you on board. So that's sort of, we were already on that path, but Craig was really the missing ingredient that we needed to really focus on that that onboarding, that nurturing, that education, the real selling the value of both worlds, not just the assets, but the debts plus the property. And, it's early days. We're still figuring out. This is not we're just looking for two partners. This is, this is a 10, 15, 20-year play for us. I've got a 3-year-old and a 1-year-old. We're not looking to do this till they finish school. So, this is going to be slowly but surely just really try to help solve this problem and encourage other brokers to come on board because, there's a lot of planners and there's a lot of people who need help. We can't do it all as a business. So we're in that curious learning stage and building everything.
Where did the whole education piece come from? Like, you're obviously running your own podcast, an opportunity to speak to lots and lots and lots of people lots of really smart people around the place. But this whole, like, the idea of where did you build your foundation of knowledge from around, what's a good property decision versus what's a bad property decision? Like, where did that originate from?
Well, I mean, similar to Craig, what Craig was saying around, like, buying a property, I think it was, like, back in 2011, I'd say 4 years in the UK as an advisor. 1 year I was working at an A&P practice, and then I was, looking at jobs, right? Moved back, only under a year experience in the Australian market. And just luckily I had an offer from this Property Planning Australia, which was a financial planning business, a mortgage broking business, and they didn't really do buyer's agency. They sort of said they did, but they referred it out. And I was the planner, and I was doing meetings with mortgage brokers, and the clients went from 60s, 70s, 80s, that I'd done the last 5 years to, 20s, 30s, 40s. And I was doing the conversation around the risk, around what are you guys doing with your super? Look, do you want to put a long-term plan? And a lot of them said, no, we just want to buy a property. And I was watching the mortgage broker have the conversation. I was like, this is just a really interesting chat. And I really want to help younger people because it's the foundations of, a lot of people in their 50, 60, it's sort of damage limitation, right? Like, I want to retire at this stage and in my investment options. So I fell in love with helping younger people. And then I slowly but surely, especially over those first 2.5 years, I just saw thousands of people that they had on their client book and what they'd done and what had worked, what hadn't worked. And I just started testing and researching and speaking to buyers agents. And it's been a snowball effect. I remember even early days in business, I don't know anywhere near as much as I do now. And so it's probably been since 2012 to now. So we're looking 10, 11 years of just constantly thinking about this, learning, researching, and then making my own decisions along the way as well.
Yeah, gotcha. Yep. And Craig, maybe you can comment on where do your lending clients come from? Like, where do they come from? Is it just they come from the podcast? Is it your website? Other financial advisors? Like, what's the network look like? Where do the new inquiries come from?
Yeah, I think as Chris mentioned, curious is probably the mantra at the moment for me. So when I joined, I just went back through all of the intro calls for the last 12 months, and I just wanted to have a look at how it worked. Selfishly, I wanted to know what to do on that call from what was working for the others. So really green in that space and just trying to absorb as much as I could. And there was, and Chris will pick me up on this if it's not right, but it seems like the podcast, LinkedIn, referral partners, being planners and those sorts of things as well are the majority there. I think there's a couple of other opportunities that are in the midst that Chris might like to touch on as well. But I think some of that stuff, you're looking at those traditional referral partners and then also coming back from clients. So the team does a follow-up call after a loan settles with every client. And one of the things they talk to them about is their experience and whether they'd be comfortable speaking to other people about it. And I would say that, those emails get shared with the whole team, and Chris pointed out how good that email is to read. There's for two reasons. One, we know very clearly what's not working. So yesterday we had an example that they said they were a bit confused and wanted a timeline of what happens at each step. So I just move it from there into a project, and that's a project on my list to work on, is a timeline for clients at each stage. And so we get feedback constantly on those things of ways to make those small improvements all the time. I was saying to Chris yesterday, my project list is about 24 at the moment. But I think that's a good thing, is that we're able to then prioritize those. They're not lost and they're not not all being done, but they're on the board, right, to look at. So then the question's asked is would they feel comfortable referring? And I would say, Chris, would I be wrong in saying that 9 out of 10 would be comfortable? Not saying that they do. Saying they're comfortable to do it on the phone and sending their friend is a different thing, but it is a big source of that as well.
Yeah, but I'm sure your process is strong enough and the experience is good enough that a fair few of them probably do, refer their friends or family or whatever it is.
I think it's that experience that you were talking about too. I experienced it personally as a customer. I didn't really know what to expect out of the whole thing, but we sent Chris 6 properties that we were looking at that our buyer's advocate had suggested, and Chris said no to all but 2 of them. and I thought that was a really unique offering. I didn't expect that at all, but I think that level of experience, when you come in there expecting, like you were sort of saying, that facilitation of a loan, and you get all of this, it becomes a very different proposition that it's hard not to talk about.
Yeah, but that's interesting, Chris, that you rejected 4 of the 6. Can you comment on, and we don't need to know the address of the house that you're looking at buying in Melbourne, but what is it about them that, you rejected some and said these ones are decent? Like what is it?
It's pretty easy to tell as well. I don't really know what those were at that time or whatever it is, but there's usually there's a process, right? And it's going through the fundamentals. So straight away, I'll jump on the map and I'll see, what the street is, right? I'll usually know the suburb because you see the address, and every suburb's probably got good properties within it, within reason. It's usually the street is a deal breaker. Great streets don't turn over that often. So it's very hard to buy on the best streets because people in them know that the best street. So usually the street's a deal breaker. Could be a busy road, could be a rat run. And you can figure those things out pretty quickly. Could be the aspects is the next thing. Like it could be in Melbourne, Craig's trying to buy it south facing in Melbourne, and that's facing the rear of the property where you spend most of your time. You want that to be facing north, not south. And it's a much different proposition to live in the winters in Melbourne. And so a lot of that, I think that's a bit of a deal breaker for a lot of property. Privacy can be a problem. I mean, when Craig was looking at, there's an apartment block over the back, and there was some bamboo shading it. But, ultimately it's privacy is it's a key thing. When you're in a property that's super private versus a property where you got someone looking over your back fence or so privacy is a big one. The floor plan, even just the front. In Melbourne, for example, everyone loves the beautiful frontage, right? Yeah. And, it's just that quintessential thing. When you're doing well financially, you want a beautiful looking streetscape. So important. Yep. And not every property has those heritage features. Even just the layout or the size of the block. If you're looking in a city in Melbourne, a lot of blocks are too small where to upgrade it to a 3 or 4 bed, it just gets not enough living spaces. You could have, they're probably a big one. Distance from transport. There's black spots in suburbs where you can almost be, 1.5 k's from the train or the tram, and, too far away from the cafe culture, where, ultimately people in that suburb, if they had money, they wouldn't want to be in that pocket. They'd want to be in this pocket. So you see that pocket disconnects the stuff where everyone really wants to be and where it's just going through that process. The ideal, Craig's pursuing one at the moment. This will be sold after this podcast. But it ticks all the boxes. Great suburb, north-facing rear, surrounded by other houses that aren't going to create issues with privacy long-term. Beautiful frontage, great floor plan, easy to renovate and add value to. And so it's just trying to tick as many boxes, and just some things are deal breakers where you should just really hold off. And sometimes you haven't got the choice in a real hot boom market, because by waiting, you're actually making it even harder to buy those good assets because they're running on you and your budget's limited. So sometimes you have to bite the bullet and go a 7 or a 6 out of 10 is good enough. But in this type of market, you hold off. We had a client buy this week, and we have a WhatsApp group, and I was, so-and-so bought, and I was like, God, that must have been 2 years. So I just out of curiosity, I went and had a look at our first email, and it was 2 years to tomorrow. So it was actually 1 year, 364 days. Yeah. So I was wrong. But he was so patient, and he bought in Mossman in Sydney, but he just bought an absolute cracker at the end of it, Yep. And so patience and persistence pays off. And so that's what we sort of encourage.
I'll just to add to that, I think it only highlights that Chris's planning brain never switches off, if that makes sense. And I'm not saying that the buyer's advocate sent the wrong properties, but what I'm saying is that Chris knew me personally and knew Carly and what we were looking for as a family potentially better, if that makes sense, because of for us, we got that personal relationship, but that's not unique to me. It's kind of the way that you operate, Chris, in terms of understanding deeply what people are looking to do so that you can comment to some of those things that might have been overlooked by something that came through as a good property, but it's not necessarily a good property for Carly and I, if that makes sense, based on what Chris knew. And I think I don't think that can be undersold as well from the knowledge that you get from people, given that curious brain that you have that I think comes from a planning background.
And those points that you mentioned about privacy and the good streets and all the rest of it, would that type of approach be any different if it was a home to live in versus an investment, or would you still be looking for those exact same things?
Exactly the same, because ultimately the price of the property is really based on who wants to own it and not who wants to rent it, right? And, because when you ultimately sell it, the market's driven by owner-occupiers, 70%, but some marketplaces, and the marketplaces you really want to buy in are probably 80 or 90% driven by people want to buy there and go into a lot of debt and take on a lot of debt, because ultimately it offers amazing lifestyle to their family, and it gives them, whether it's access to the city for work or the schools or the culture and the lifestyle around that and the beach and the water and etc. So the more boxes you can tick from a high income family owner occupier market, that's ultimately what you want to be buying from an investment or a home. I think just the home is just your biggest opportunity. And I think this is why the planning space, I think it's probably our next evolution of the planning space is can look at both sides of the balance sheet. Go look. Okay, what's all your assets? Okay, let's look at your super. Let's all look at your shares, etc. But let's look at your home. Like, is that a good asset? What are you going to do long term? Are you going to live there long term? It's a tax free asset. We look at the super changes this week. What can we optimize that? How do we optimize that? And and I think that's something that we really spend a lot of time on. And if they are got other investment properties, like, are those investment properties really working for you? Like, a lot of people will just say, I don't want to sell that. You never sell. Those sort of all these myths around property. Yeah. But is it better to take that debt and pay off the home and then re-debt cycle into some shares, or is it better to look at an investment property, etc.? If a client comes to us trying to buy a property and self-managed super funds, we'll be like, no, we just don't do it. And so it's probably just looking at the assets, but then also the debt. I think ignorantly and arrogantly, I thought mortgage broking would be pretty easy, like coming from a planning background, but there's so much to it. And even just restructuring loans and extending loan terms and, maximizing interest only and using offset accounts wisely and then releasing equity and building buffers regularly. And I think there's a real value add in just as part of a planning process is every year reviewing that debt structure and optimizing it. And even particularly more because the loyalty tax has gone next level in the last few years. It's just crazy. It's just easy wins for planners, I think, is going there, saving the client some money because it can happen really fast. And then there's that value exchange and the planner comes across as the hero because ultimately they're the ones who made the referral. And so this is sort of what we're building out bit by bit.
I guess, Chris, James, just with this, I guess one of the things is just talking to lots of planners and asking what that, most of them know, if you've been doing planning for a while, you've got a network of people that you like to work with. So it could be the brokers, the accountants, the lawyers, those sorts of things. And I've just been really curious to know, what does it look like? What's working? What do you think could be there? And just really just trying to understand what it is that is there. There's some really good relationships that are there, and I've learned a lot from just asking questions. And one of those was capturing the review date for your planning clients as brokers. So why don't we know for those referred clients what the review date is, so we can provide you with a loan schedule ahead of time, a rates card to compare what it is with what's in the market, the script that I know you spoke to about the Macquarie Bank, the link that you went through, and all the stuff. I even saw your video on the revaluation that you had to do to get your home LVR attributed correctly. How do you take that stuff into your meeting ahead of time? We've got all that data, but we're not using it. I'm not a crazy rocket scientist, but I like listening, and I'm curious, and I just want to try and take those things and make it as easy as possible for all of us to make that experience for the client as good as it possibly can, and make the person referring us look like a hero that they already are, but just improve that from that visibility perspective as well.
Yeah, fantastic. And maybe the last couple of things that I'll get you both to comment on. Can't have you on and not get an opinion on the property market and direction. And Chris, you often you'll put up a lengthy post on LinkedIn whenever you've had a conversation with a client or something and give us your view. But we're getting it all the time, certainly with younger clients. What's going on with my mortgages? Should I be fixing? Should I go variable? How much longer is it going to go up? I know no one really knows, but can I get your 2 cents on the whole topic and versus the property market? Is it going to keep falling? Do you think we're due for a turnaround?
Yeah.
Is there pent up demand for on the buy side, so maybe it's not going to fall too much further? What do you think?
I think it's the property market's a big name. It's like the equity market, right? And unless you're buying the index, that's you're buying individual companies, and the property market works more like individual companies, right? It's individual properties that have all got different balance sheets and all got different demand and supply metrics, right? And I think that the planners need to shift from that, because the media reports on the property market, right? They don't report and properties actually individually, you own one property on one street, on one side of the street, and that's a mini market in itself. And so I think that's I always have to kind of make that, context. Because there's many markets that have got really poor fundamentals from a supply point of view. You think about high density apartments, right? They keep building more of them. There's a lot of them. And then the demand's really patchy, right? A lot of it's investors and singles and couples, and it's not the family market. And then there's building issues, etc. So every market's behaving differently and adjusting to higher rates. That means that ultimately at the moment, it's a story of where rates stay and finish, and where they stay and how long they stay at certain levels. Yesterday we had the chief economist at ANZ for 10 odd years, Warren Hogan, came on the podcast, right? I think he was quite insightful in terms of what he was saying. He was the one who was calling RBA rate at 4.5% last year when no one else was. But even his view is that, we've got a lot of tightening still to go, maybe even up to 4.3% or something. But then whatever comes on in terms of interest rates from here will likely have to come back once they get the genie back in the bottle, right? And so what's ultimately happening is the market's freezing up. CoreLogic yesterday, it's the start of March now, released new listings numbers in February. There was nothing. If you open up your portals, you'll see what came on. Nothing good came on, because everyone in a good property right now is saying, why would I sell to upgrade when rates are high and I don't know what rates are, and I've got a great property? I even don't want to do a reno. We had a client pull out of a reno yesterday. Just that fear of unknown. People just sit still. So you're seeing this real contraction of listings, and any property on the market's is usually not a great asset. All those things we spoke about before. So very little supply, and property's priced on the marginal buyer. So, or any asset is really. And so, if there's 10 properties for sale and there's 12 people who want to buy them, and those 12 people are really hungry and have got good budgets, then property holds its value. It's only when you see this flood of listings and a real drop in buyers that you start to get this fire sale event. And so a lot of the premium markets right now, very tight listings, and buyers have already done their readjustment. Last year was that freak out event, August, September, October. Everyone thought rates were probably going to go up slowly, and then they went up fast, and everyone was like, I don't know what's going to happen. And there was still a bit of stock on the market then, because people had either bought or had done the effort to, get it ready for sale. That was amazing buying. August, September, October. By the time November came around, listings got dry, and December, really. And so it was actually the best buying was back then. And no one would really say that. But if you go back in time, that's when we saw the clients get the best deals. Now there's actually more competition for the amount of properties on the market, we're finding. And so there's support in the market, and you're actually having to go into some type of competition to buy usually. So that's all the properties our clients will buy. We don't go and buy in areas that have got supply fundamental problems. They've got demand problems. It's where, there is really tight supply at all times. And there's a growing demand from people who ultimately have a lifestyle need. That pent up demand you spoke about, James, in Sydney and Melbourne is significant. People who aren't in houses that they want to live in as their forever home. There's a lack of those. And there's a lot of people wanting to upgrade into them that have missed out 2022, 2021, or maybe they just had a baby in the last couple of years and now they're ready to get into that house. So yeah, I think there's a media story, but we've already started to see that, there is a bit of support in the market. I think we could have a bit of a second wave of a downturn, though. This is the thing that Chris Joy's talking about at the moment, and is that there could be another freak out event if RBA rate goes past 4%.
Yeah.
I think if it stays under 4%, the market's already factored that in. But if it goes to 4.25, that's a mindset shift over that 4. And I think that would be also a drop in demand, and people would want to wait till there's a plateau in rates or fall in rates. And so I think that could be another buying opportunity, but nothing's guaranteed, right? Like, we don't know if rates are going to go that high or whatever, but that could be another little correction in prices. But if rates stops going up now, I think the best buying's already gone.
Yeah,
and
gotcha.
So it's a rate conversation. It was only 2 months ago the market pricing was, I know this is a long answer, it's a big question. The market pricing was, say, around 3.6 for the RBA. So that's what shifted. The Australian government has realised that the Australian economy is quite resilient, and not everyone's got a mortgage, and people are still spending, and people are still moving here from, overseas, and, students, etc. And we're still going at too fast of a knot that these interest rates aren't biting, especially with the fixed rates problem that we created in COVID by fixing all our loans. And so watch this space, James. But it's just get individual markets, individual properties. If you want to know what's happening, get on the ground. Go to an auction, ideally a similar property to yours as you can, and call the agent and go to the open homes. See what's happening, and see, and you might be surprised. Actually, you know what? That actually sold. That's not what Domain, that's not what, the new media is telling me.
That's what they're not going to tell me on the news tonight, that this property sold for a decent price.
In my suburb, that was actually the same as mine. Why am I, watching the news freaking out when I just saw that sold? It was 6 buyers on one property and there's no other properties on the market.
Craig, you mentioned it, gone through the exercise with Macquarie about the refinance, and Chris are kind of doing some of what I'd seen you writing about before: stretch the mortgage out, reduce the repayments down, release some equity, build the buffers, that kind of thing. And I'm going through that process at the moment, and I have no intention to use this money that I'm releasing, but awesome. I can. Where the valuation came through from the valuer from the bank, and the mortgage broker sent me an email saying, guess what it was? I had a particular guess, and he came back with this price. I'm like, there's no way in the world that it's like. I couldn't believe how high this was given the sentiment and what we're hearing in the news, that it should be low, it's going down, it's gone down, it's gone down. And you're like, the hell, this is, it might have just been a fluke valuation from the valuer, but... That sounds like a fluke, James.
When you get those, act.
And that's what we've done.
Yeah.
So that's what we're doing. It happened to
me last year. I got a place in Melbourne, and it's probably, on a good day, 1 to 1.1. And we got about 1.25. Look, it's an education here. What we did, released equity. That allows us to build buffers. It allows us to potentially spend money on renos. It allows us to, buy other things. Other assets, etc. You do need to be careful though with clients that are getting high vals. There's an education process that you're potentially getting equity well over 80%, and that if you basically have a loan, in that scenario, James, you may have a loan of up to 100% at residential rates, which is an amazing opportunity, but it just comes with risk of knowing that if you ever had to sell and you'd use that money, you might not have any money left over or go into negative equity, etc. But those freak valuations do happen, and they can create great opportunities for people to do other things, that they may not have been able to do if they had a low valuation, for example.
And I think just on that point, with when that sort of stuff comes up, I've seen it happen with a number of people, is that Chris is like, well, you can't buy a quality asset with the equity that you've released. So this would be the time to go back and speak to James about dollar cost averaging, these sorts of things, that you should be having that conversation with him, and potentially property's not the right investment for you right now with that extra money. And I've really appreciated seeing that conversation that's come backwards to say, look, you've got this, don't go and get a property that gets us another loan that, hooray, we're making money. It's like, this is the wrong decision to be making for the principles that we use for you to buy your home. Go and chat to your advisor about this, because this is where you could start to unlock some other opportunities and diversify your asset pool as well. So the practicing what he preaches on that one it draws me to Chris. And I mean, we've known each other for a long time personally, but professionally, it's only impressed me even more being on the ground and seeing it every day, that it really is genuine. And I think that's the big thing that we both had over this journey. It's that it didn't matter what we were doing. We just try and tell the truth, or our truth, if that makes sense, and not hold back on that one too. And I think that's where we're quite similar in that way in both sides of the coin. If I don't know something, I'll tell you. If Chris knows something, he'll tell you. And I've always liked that about him.
Look, guys, we might wrap it up there. Thank you for joining me this morning. For anyone that doesn't know where to find you, and if they want to reach out, connect or whatever, where can they find you? Give yourselves a bit of a plug.
So we've got a new brand launching in a couple of weeks, so that it's going from Wealthful to Blusk. And so it'll be blusk.com or .au. I don't know if we're doing .com or .au yet. That's one of our decisions. But obviously we can catch us both on LinkedIn, etc. I think that it's a big conversation for this. This is not something that, in 2 years' time we'll be doing something else. This is something we're trying to really change at a big level, and if you've got any relationships with brokers as a planner that's really working, like, we don't definitely want to interrupt that relationship. But if you've got any little tips on why it works so well for you as a planner, I would love to hear, because, we'd love to be including that in our offering and educating other planners to have that in their brokers and other brokers in the future. And so this is a team effort. I'm not someone who's in a scarce mindset, or it's a complete abundant mindset. And we're trying to get other brokers on this journey and other planners in it. And and work as a real team, which should be happening with professionals, right? But unfortunately, we all know that doesn't happen as much as it should. And thanks so much for having us on, James. And
that's all right. Thanks for joining me. Thanks, Craig.
Appreciate it, mate. Thank you.
Good to speak with you both. Catch up with you separately another time, I guess.
Sounds good, mate.
Awesome. Cheers.